Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
Usually, when global shipping supply chains break down and freight prices skyrocket, manufacturing companies panic. Like, margins get crushed, stock prices drop, and the whole industrial sector just braces for impact.
Yeah, that is the standard logic.
Yeah.
You normally assume friction in global trade hurts everyone.
Right. But today we are looking at a multi-billion-dollar energy giant that actually makes more money when global shipping gets expensive and raw materials get trapped. It's wild. It completely flips traditional economic logic on its head.
It really is a fascinating dynamic
Yeah.
because when your entire business model is built around processing the absolute cheapest, most difficult raw materials available, global supply chain friction can actually become a massive competitive moat.
Exactly.
Yeah.
So if you want to understand the real mechanics of the energy sector, like the actual gears turning behind the daily commodities headlines, this deep dive is for you. We are unpacking Valero Energy Corporation, ticker symbol VLO.
And we've got some great material to work with today.
We do. To build this picture, we are pulling from two phenomenal sources. We have a highly detailed new research report from Compasscope dated April 6, 2026. And we are pairing that with the transcript from Valero's Q4 2025 earnings call.
The combination of those two sources is really powerful. I mean, the Compasscope report maps out the physical infrastructure, the massive movable assets Valero owns.
Right, the nuts and bolts.
Exactly. Then the earnings call reveals the tactical decisions the management team is making week to week to navigate, an incredibly volatile global market.
And to understand those tactics, you really first have to grasp the sheer physical scale of what Valero actually does, because they aren't just a gas station brand. They were generally categorized into three main business lines, right?
Yeah, that's correct. Three main buckets.
The refining side is obviously the anchor. The Compasscope report outlines 15 refineries, predominantly clustered along the U.S. Gulf Coast. But what caught my attention wasn't the number of refineries.
It was the complexity rating.
Yes. A specific metric called a complexity rating, which sits at 11.8. Now, I know an 11.8 rating implies a highly sophisticated setup, but mechanically, what does that actually allow them to do that a standard refinery cannot?
Oh, well, a simple refinery essentially functions like a giant boiler. You pump in light, sweet crude oil, the expensive, high-quality stuff, apply heat, and separate it out into gasoline, diesel, and other products.
But light, sweet crude is expensive.
Very expensive.
Yeah.
So an 11.8 complexity rating means Valero has invested billions in advanced secondary processing equipment, things like hydrocrackers and cooker units.
Okay.
These units use extreme heat, pressure, and chemical catalysts to physically break down heavy, sour, sludgy crude oil.
I was trying to visualize this, and it feels like the equivalent of a high-end chef who purposely goes to the market and buys the cheapest, toughest cuts of meat.
Oh, that's a good way to look at it.
Like, they buy the heavy, sour crude because their kitchen has the specific slow roasters and pressure cookers required to break down that tough tissue and turn it into a premium, top-dollar steak.
The math on that analogy checks out perfectly. Because that heavy, sour crude is so difficult to process, producers have to sell it at a massive discount.
Right.
So Valero buys that deeply discounted raw material, runs it through their highly complex kitchen, and outputs the exact same high-margin refined products as the simple refineries.
That is incredible.
Yeah, that complexity rating is literally the mechanical engine driving their profit margins.
But they don't just rely on the refining engine. The report also details a massive logistics arm. We are talking 3,100 miles of pipelines, 130 million barrels of storage, plus a sprawling network of rail cars and marine docks.
Owning the plumbing is a crucial part of the margin capture. I mean, if you rely on third-party pipelines to bring in your cheap crude and move your finished gasoline out to the market, you bleed profit at every toll booth along the way.
I see.
By owning the storage in the pipes, Valero captures the economics at every step of the molecule's journey.
That makes total sense. Then there is the third line of business, which feels like a completely different industry to me. Low carbon and renewable fuels.
Yeah, it's a huge focus for them.
They have a 50% stake in the Diamond Green Diesel joint venture with Darling Ingredients. They are producing 1.2 billion gallons a year of renewable diesel alongside a massive ethanol business.
And the integration there is brilliant because Darling Ingredients is one of the world's largest producers of animal fats and used cooking oils.
Oh, so they provide the waste feedstock.
Exactly. Darling provides the waste. And Valero provides the massive industrial processing expertise to turn those waste fats into renewable diesel that is chemically identical to traditional petroleum diesel.
Wow.
It is not a side project at all. It is a core pillar of their cash flow.
Okay, so we have this highly complex refining system, an internal logistics network, and a massive renewables arm. But they operate in a brutal industry.
Very brutal.
And comparing them to their peers in the CompuScope report, I noticed a stark difference in corporate strategy. Like companies like Marathon Petroleum, MPC, rely heavily on their midstream pipeline subsidiary, MPLX, to guarantee steady fee-based revenue. And Phillips 66 uses a massive chemicals division to buffer their earnings. But Valero is strictly a pure-play refiner.
They are entirely uncompromising on that front. They do not want the distraction of a standalone chemicals business. They just want to refine complex feedstocks and sell fuels.
But I have to wonder if that is a massive strategic vulnerability. I mean, if you are entirely dependent on refining margins and those margins suddenly compress globally, you have no chemicals division to catch your fall.
That's true.
Marathon and Phillips 66 have built-in safety nets. Without those, isn't Valero completely exposed to the whiplash of commodity cycles?
You are identifying the classic risk of a pure play model. But Valero's management has engineered a different kind of safety net.
Okay, what is it?
Instead of diversifying into different industries like chemicals, they diversify geographically through sheer export volume. Valero has an export capacity of 700,000 barrels per day.
Whoa.
Yeah, that is the highest among all independent U.S. refiners.
Meaning they use the global market as their shock absorber?
Precisely. If U.S. domestic gasoline demand suddenly plummets, or if the local market gets flooded and prices crash, Phillips 66 might lean on their chemicals business.
Right.
Valero simply loads their surplus product onto their owned marine docks and ships it to Latin America, Europe, or West Africa. They continuously hunt for global arbitrage opportunities.
So if the margin is better in Brazil than in Texas, the product goes to Brazil.
Exactly. And they apply a similar scale advantage to their low-carbon segment.
Yeah, the report touched on smaller pure-play refiners like PBF Energy or HF Sinclair. They are also trying to navigate the refining cycle.
But Valero's Diamond Green Diesel platform is operating at a global scale that those smaller players just cannot match right now.
Because the barriers to entry are just too high.
The barriers for processing 1.2 billion gallons of renewable diesel are staggering. You need the capital, the complex engineering, and most importantly, you need the secured supply chain of waste fats.
Which Valero locked down through the Darling Ingredients partnership.
Right, creating a massive economic moat in the low-carbon space.
Which naturally leads to a question about their growth strategy. I mean, if they are committed to remaining a pure-play refiner and they already own the largest export capacity and a massive renewables joint venture, how do they actually grow?
Well, the CompuScope report makes it abundantly clear that the era of building massive new greenfield refineries in the U.S. is completely over.
Right. The capital costs are too high and the environmental permitting is virtually impossible.
So growth for Valero is entirely about internal optimization. It is about wringing higher value yields out of the exact same physical footprint.
Because they aren't spending $10 billion trying to build a new refinery from scratch.
Exactly. They can deploy highly targeted capital into their existing facilities.
I saw a prime example of that at their St. Charles refinery. They're spending $230 million on an FCC optimization project, set to come online in late 2026.
Yes, that's a key project.
But the report doesn't really explain the mechanics. How does an FCC project actually generate growth without expanding the refinery's total capacity?
So FCC stands for Fluid Catalytic Cracking. Think of a barrel of crude oil as a mix of different size molecules.
Okay.
The heavy, low-value stuff has large, long molecule chains. The FCC unit uses a powdered chemical catalyst mixed with intense heat to literally crack those large molecules apart into smaller, much more valuable molecules like gasoline and propylene.
Oh, I see. So the optimization project is about increasing the efficiency of that cracking process.
Exactly. Upgrading the FCC unit means they can feed it heavier, cheaper sludge, and the unit will successfully crack a higher percentage of it into premium products.
Fascinating.
And they're also doing this with their coker units. They completed a major coker project at Port Arthur in 2023. These aren't flashy mega projects, but they relentlessly drive down the average cost of their raw materials while increasing the value of what comes out the other end.
It seems like a low-ceiling strategy, though. Like, if you are just tweaking the margins on existing plants, the upside has to be mathematically limited compared to a company opening a massive new facility.
The upside might be less explosive, sure, but the capital risk is exponentially lower.
Yep.
Look at the integrated majors of the Exxons and Chevrons.
Right.
When they greenlight a multi-billion-dollar new facility, they take on severe construction delays, massive cost overruns, and technological risks. Valero's targeted projects generate massive, predictable cash flow because they are upgrading equipment they already know how to operate inside a facility they already own.
It's like their growth strategy isn't buying a new car. It's hot rodding the vintage car they already own to go 10 miles an hour faster.
That is exactly what it is.
And that optimization playbook applies to their low-carbon fuels too, right?
It does. They are currently converting existing physical capacity to produce 235 million gallons a year of sustainable aviation fuel, or SF.
And on the ethanol side, they are re-engineering their plants to capture the new 45Z production tax credits.
Squeezing every drop of regulatory and market value out of the steel they already have in the ground.
Which is incredibly disciplined. But, discipline doesn't eliminate risk. Let's look at the execution risks highlighted in the sources.
Okay, let's get into it.
Their balance sheet actually seems the least of their worries. Their net debt-to-capital ratio is sitting at roughly 18%, which is phenomenally conservative.
Yeah, their target at 20 to 30% ratio, sitting at 18% gives them a fortress balance sheet.
So if a severe global recession hits and refining margins collapse,
Valero has the financial padding to survive without cutting into their core operations.
So financial execution is solid, but there is a massive physical execution risk detailed in the earnings call, and that is their exit from the state of California.
Yes.
Specifically, the phased idling of the Benicia refinery. Now, California has incredibly tight fuel supply chains and severe environmental regulations. Walking away from a major physical asset out there while still fulfilling existing supply contracts seems incredibly precarious.
It is very tricky. The management team addressed this directly on the earnings call. They are facing mandatory, highly expensive inspection requirements on the process units at Benicia.
And I want to pay for that.
Right. Instead of sinking capital into a market they want to exit, they decided to idle the refining units. But you're entirely correct. They cannot just flip the off switch without triggering a supply crisis in the Bay Area and breaching their commercial contracts.
It's almost like trying to keep a popular restaurant open and serving your regular customers while quietly dismantling the actual kitchen in the back. You have to secretly order takeout from across town to fulfill the orders on the floor.
That's a hilarious way to put it, but yeah.
Yeah.
The takeout in this scenario is imported gasoline.
Okay, how does that work?
Valero is utilizing the existing docks and storage tanks at Benicia to import finished gasoline and blending components. They bring the fuel in via ship, store it in their tanks, and send it down their pipelines to satisfy their supply contracts. They are basically functioning purely as a logistics terminal while winding down the chemical processing.
Doing that seamlessly requires immense coordination with state regulators, workforce management, and marine logistics. If a single imported cargo is delayed, the whole facade could crack.
The risk of a supply disruption is high, but by executing a phased idling and leveraging their importing capabilities, they are attempting to engineer a soft landing rather than an abrupt, chaotic shutdown.
Well, that structural agility really showed up in their Q4 2025 earnings results. The numbers discussed on the call were staggering.
They really were.
They processed 3.1 million barrels of crude a day, maintaining a record 98% utilization rate across their system. That resulted in a full-year net income of $2.3 billion, and they backed it up with a 6% dividend increase. The machinery is running incredibly hot.
I mean, running at 98% utilization in the fourth quarter is almost unheard of. Refineries typically use the winter months, when driving demand drops, to take units offline for maintenance.
And that relentless utilization created a very strange anomaly in the market. The analysts on the call zeroed in on a heavy buildup of light product inventory, specifically gasoline sitting in storage tanks down in the Gulf Coast, which the industry refers to as PDD3.
Right. The analysts were trying to figure out if consumer demand was collapsing. If gasoline is piling up in tanks, the natural assumption is that people have stopped driving.
But Valero's management clarified that domestic demand was actually perfectly flat year over year. Exports were also flowing out at high volumes.
Exactly.
So the fuel wasn't piling up because of weak demand. It was piling up because the refineries simply refused to slow down.
Yes. The profit margins on distillate products like diesel and jet fuel were incredibly strong during that quarter. Refineries wanted to capture every penny of that distillate margin.
But crude oil is a packaged deal, right?
Exactly. When you run a barrel of crude to maximize diesel production, you inevitably produce gasoline as a byproduct. The weather was moderate, avoiding freeze-offs, so the refiners kept their foot on the gas to chase the diesel margins.
And the byproduct gasoline simply backed up into the storage system. That's it. Which brings us back to that incredible dynamic we discussed at the very beginning. I was reading through the Q&A portion of the transcript, and an analyst asked about global freight rates.
Yes.
And it blew my mind that higher shipping freight rates actually help Valero make more money. We touched on this earlier, but mechanically, how does a spike in shipping costs lower their raw material costs so drastically?
Okay, think about the heavy, sour crude producers up in Canada or down in Venezuela. They pull this heavy sludge out of the ground, and they need to sell it on the global market.
Right.
To do that, they load it onto marine tankers to ship it to specialized refineries in Asia or Europe.
But if global freight rates jump 30%,
The cost of chartering those tankers destroys the producer's profit margins. Suddenly, the Canadian and Venezuelan producers cannot afford to ship their heavy crude across the ocean.
oh, so the barrels become geographically trapped in the Americas.
Yes. And the producers still have to sell the oil because they can't just halt extraction without damaging their wells. So, to incentivize local buyers, they have to drastically widen the discount. They slash the price.
And who is sitting right there on the U.S. Gulf Coast with a massive pipeline network, deep water docks, and an 11.8 complexity rating specifically designed to process heavy crude.
Valero.
It's just perfect.
They don't have to pay the exorbitant ocean freight rates because the trapped crude is basically in their backyard. The Canadian and Venezuelan crude flows down to the Gulf Coast, and Valero feasts on it at massive discounts.
Yeah.
Their input costs plummet, but because finished products like gasoline and diesel are priced on a global index, their revenue stays high. The spread between their cheap trapped raw materials and their globally priced finished products just explodes.
That is a masterclass in positioning. But, past performance doesn't guarantee future results.
It never does.
Knowing they are running at 98% utilization with a fortress balance sheet, we need to look at the horizon. Based on the Combiscope report, what are the uncertain variables, the keys to watch that could compress these margins going forward?
Well, the fundamental driver will always be the heavy-to-light crude differential. Valero's entire advantage hinges on heavy crude being significantly cheaper than light crude.
Okay.
If new pipeline infrastructure suddenly opens up global markets for Canadian crude, or if Venezuelan production collapses, that discount shrinks, and Valero's primary competitive moat narrows.
Got it. Geopolitics also cast a massive shadow over the earnings call. I saw mentions of the enforcement of sanctions on the Russian shadow fleet, ongoing tensions in the Middle East.
Those create supply shocks that can instantly alter global trade flows and shipping rates. Geopolitical volatility is the permanent backdrop of the energy sector.
Right.
But the sources highlight an even more immediate structural wildcard, and that is the incredibly ambiguous landscape of low-carbon fuels policy.
Yeah, the amount of time spent on the earnings call discussing regulatory frameworks was eye-opening. They were debating the EPA's renewable volume obligations, the implementation of 45Z tax credits, and the volatile pricing of RINs.
RINs, or Renewable Identification Numbers, are the perfect example of how policy dictates profitability in this space. The EPA mandates that a certain volume of renewable fuel must be blended into the national fuel supply every year.
And a RIN is essentially the compliance ticket proving that blending happened, right?
Exactly. When a company produces and blends a gallon of renewable fuel, they generate RIN. If a traditional refiner fails to blend enough renewable fuel to meet their quota, they are legally required to go into the open market and purchase RINs from someone who did.
Oh, wow.
And because Valero produces 1.2 billion gallons of renewable diesel through their Diamond Green Diesel venture, they are minting massive amounts of these RINs.
They aren't just selling the physical renewable diesel, they're selling the shadow currency generated by the regulation.
Yes. The RINs, combined with state-level low-carbon fuel standards and federal tax credits, often make up a massive percentage of the actual profit margin on a gallon of renewable diesel.
Right.
But if the EPA sets the mandated blending volumes too low, the market gets flooded with RINs, the price of the credit crashes, and Valero's low-carbon profits evaporate overnight.
I want to focus on that because the general consensus Like, the story you always hear is that electric vehicles are the existential threat to oil refineries.
Right, the EV narrative.
But listening to the analysts on this call, no one is panicking about EVs destroying demand by 2030. They are aggressively questioning management about the stroke of a pen regulatory risk from the EPA happening next month. Aren't government tax credits and biofuel mandates the much more immediate make-or-break factors for Valero's bottom line right now?
Absolutely. Long-term systemic demand destruction from electrification is definitely a macro threat over the next couple of decades. But for the next 1 to 5 years, Valero's bottom line is entirely tethered to government policy. Will the 45Z tax credit provide 10 cents or 20 cents per gallon? Will the EPA crack down on small refinery exemptions? Those bureaucratic decisions instantly alter billions of dollars in cash flow. The policy landscape is the true near-term battlefield.
Pulling all these threads together, Valero emerges as a masterclass in managing complexity. I mean, they aren't building shiny new mega projects. They are optimizing a highly sophisticated network of steel and chemistry to turn the cheapest, dirtiest crude into premium products.
It's a very specific playbook.
They use massive export capacity to shield themselves from domestic market crashes, and they are leveraging their industrial scale to dominate the renewable diesel market, all while holding a pristine balance sheet.
They have engineered a system that thrives on the exact market friction that breaks other companies. Whether it is shipping bottlenecks, heavy crude gluts, or complex biofuel mandates, Valero has built the infrastructure to capture the margin.
It is a remarkable industrial machine, and it leaves me with one final, somewhat provocative thought for you to chew on.
Okay, let's hear it.
We tend to view the energy transition as a battle between clean tech startups and legacy fossil fuel dinosaurs. But as government policies increasingly mandate massive volumes of low-carbon fuels and sustainable aviation fuel, you have to wonder.
Wonder what?
Could traditional, dirty refining giants like Valero, armed with their massive balance sheets, existing logistics networks, and absolute mastery of complex chemical engineering, ironically become the ultimate gatekeepers of the green energy transition?
It is a profound question. Processing millions of gallons of waste animal fat into complex aviation fuel requires the exact same industrial horsepower and capital discipline as refining crude oil. The infrastructure is already there.
They were just changing the ingredients in the kitchen.
Exactly.
Well, thank you for joining us on this deep dive. The next time you see a commodities headline about global shipping rates or EPA mandates, you will know exactly how it impacts the actual mechanics of the energy sector. Catch you next time.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.